NVIDIA is a company with astronomical growth to their top line just over the last few quarters, as we can see here. We can also see their top line over the last year is up 265%. Their bottom line up 769% year on year. So is this a company that, despite the strong run, is still undervalued? We're going to take a look today looking at their performance. We're going to look into their income statement over the last few years, as well as their bottom line net income. We want to see, based on their latest results, how the company is shaping up health-wise, cash versus total debt. We'll also explain how they've performed versus the industry and against some very well-performed companies such as Broadcom over the last few years. We'll briefly discuss some insider selling we've seen over the last few months. We'll talk about the institutional ownership. We'll cover not just their dividend safety, which is pretty minuscule at 0.02%, but also some of their metrics like their free cash flow growth. And as always, based on the latest information, we will run them through the valuation model. Getting to our intrinsic value, we'll talk about our acceptable buy price with our investor margin of safety, and we'll look towards Wall Street to see what they're forecasting for the next 12 months. So let's start off very quickly then with their performance. They are up 233% just over the last 12 months. They are towards their 52-week high, although we do see a bit of a pullback around $30-40. Their yield very minuscule, which they haven't increased in quite some time at 0.02%, and a forward P in the mid-30s. Now, over the last 10 years, it has also been on a phenomenal run, up 17,000%, even though it doesn't include those dividends, which are pretty tiny. A very, very strong performance, one of the best over the last 10 years. Now, we'll take a quick look at their top line revenue as well as their bottom line growth, given we now have their January 2024 numbers. And what we can see, their top line, they reported $11 billion in 2020. Around 5 years ago. Now they've reported $61 billion. So we're looking at growth nearly 6 times over the last 5 years. And what we can see in actual fact is, whilst it did increase from 2020 to 2021 and 22, it remained pretty flat from 22 to 23 before a staggering increase over 100%, absolutely phenomenal, to $61 billion. Now, we'll also talk about whether or not this is sustainable later as well. So how does the bottom line shape up in comparison? Well, even better. We've gone from $3 billion or just under in 2020 to $30 billion in 2024. So more than 10 times growth on the bottom line. And again, pretty similar story to the top line. We've seen growth to 22 before we see a drop and then picking up very, very strongly. So we can see their bottom line has performed very well. And what we want to show you here is that also their gross margin is up 12.6 basis points to 76%. So not only have they been increasing their top line as well as their bottom line, but they've also been improving on that gross margin by around 12.6%. We can see that a lot of the growth from the top line has come from that data center revenue, which is up around 409% year on year. We can also see essentially their earnings per share up 765%. So a lot of positives to note with this company. Again, what we need to be thinking about is the sustainability looking forwards, given these increases and what the market will now assume of them going forwards. So in terms of a quick cash versus total debt analysis, $11 billion of cash in 2020, $26 billion in their latest report. So they hold around 2.6 times as much as they did 5 years ago. Then in terms of their total debt numerically and directionally, we can see this increase from around 2.6 billion to just over 11. So yes, their total debt has increased by around 5 times, but we also note their cash is very, very much higher than the total debt. So no worries, especially when we'll look at their total debt versus net EBITDA metrics. So a quick comparison versus Broadcom, TSM, AMD and a few others. Over the last year, we can see NVIDIA performing very, very strongly, 233%. We have the next best performing Broadcom up 127%. So just a few weeks ago, Broadcom was one that was talked a lot as a very strong contender of one of the best semiconductors. We now have NVIDIA completely smashing them out of the park. Over the last 5 years, 1,902% up NVIDIA versus Avgo around 449, and we also see AMD looking very strongly at 614. Now the thing to point out here, especially for new viewers, is just because NVIDIA have brought these returns over the last 5 years, even over the last 10 years and beyond, do not expect this moving forwards. It is never really indicative of past performance to future performance. Now, in terms of insider buys and sells, again, what we wanted to draw out here is, to be honest, when we bring this down to the last month, where we see a lot of growth on their share price, we have no insider buys or sells. Now, when we extend this to the last 2 months, and again, this includes buying and selling, we see some sales by the directors, the principal accounting officers. What we're really trying to draw out here is two things. Firstly, insider buying and insider selling are two different things. When insiders buy, that is a bullish signal. They buy because they believe the share price will go up. Insiders sell is not necessarily a bearish signal. They sell for personal or financial reasons. And what we want to signal here, we can see every single time they sold, in fact in January, the share price is now significantly higher. So this is more just a show for transparency rather than any indicator of the company. In terms of institutional ownership, well, it is 65%. We see it around 46.7 billion in terms of the institutional outflows. Although a lot more buying by these institutions, they do love this company. They hold a lot of it versus how much they've sold. The largest buy, as we can see, in Q2. And we want to point out that in the more recent quarter, 39 billion worth of buys versus sales. So again, they are bullish on NVIDIA, but as always, do your own due diligence and never rely on this information solely. Now this graph, as we can see, we just wanted to point out that for a long time the growth wasn't as astronomical as we see now. In fact, from Q1 2023, it did start coming down to Q3 before going back up. And we see this large increase to their revenue from Q1 to Q2, as well as the last few quarters. So what we need to understand is whether or not this is sustainable, whether or not there is the demand for these products in the future. Now, when we take a look at the dividend safety and some other metrics, we can see a score of 89. It is very safe, although a lot of people won't even really care about this given how small it is versus the share price appreciation. The market cap is just under 2 trillion, a mega cap company. In terms of recessionary metrics, no comparative data to the dividend given they didn't pay one. We see recession sales of negative 35.4% versus the S&P's negative 12%. And we can see they did trail the S&P negative 78% versus the S&P's negative 55%. Dividend growth, again, not too much to note here. They haven't increased it since 2018. On average, increased by 1% over the last 5 years and 8% over the last 10 years. So in terms of dividend yield theory, again, this isn't something that we do believe to be too relevant given that essential reliance on their dividend. But what it shows is a company is undervalued when the current yield sits above the 5-year average. So this would be a sign of overvaluation based on that. But bear in mind, we don't look at any of these models in isolation. 0.02 versus 0.1. And we can see the forward P here, 33.4, is below the 5-year average of 41.3. But still much higher than that sector P of 27.5. Now, free cash flow payout, it is something we focus on. Below 50% for the essential semiconductor firms. Now, we know not only is this decreasing, 1% in 2024, 1% in 2025 expected, pretty much shows they're not really focused on that dividend, which, to be honest, for this type of company, shouldn't really be a factor. But it would be nice to know even just a few percentage points increases just to keep up in line with that inflationary level. Now, free cash flow per share, 36 cents in 2015, 10.90 in 2024. Now, they are expecting this to increase by nearly 100%, and just bear that in mind because we will discuss that when we look at the valuation. $10.90, an extreme growth from the previous year of $1.53. So let's take a look at the sales growth. Now, double digits nearly every single year, very, very strong. 23%, we did see it pretty flat. 24, that latest year, we're looking at triple digit growth, which is absolutely phenomenal. But let's bear in mind when we do review companies that have some very strong growth, it isn't typical to see this follow year on year. So do expect a pullback to their top line. In terms of numerically speaking, well, just under 5 billion in 2015 and 61 in 2024. Now, they've done share buybacks. They've also returned excess cash to investor pockets. But what we can see is the net position over the longer term is diluting your position. 2.25 billion shares in 2015, 2.49 in the latest report. But bear in mind, you probably wouldn't care if you've been holding this company over the last 10 years, given that share price return. Now, ROIC, it is one of my 7 golden dividend metrics. I do aim for 10% or more, just to give me faith that management are able to effectively allocate their capital. 61% in 2024, absolutely phenomenal, although we do see before then it has been consistently very strong as well. Just an extremely good year for them in 2024. Now, in terms of their margins as well, looking very positive. It is also increasing, both of them. 54% in 2024, very, very strong. And we did mention earlier when we had a look here, we can see their gross margin is increased 76%, up 12.6 basis points as well. So this is a company that is also improving their operational efficiency. Free cash flow margin, absolutely phenomenal as well at 45%. Finally, the net debt to EBITDA showing us their balance sheet strength as well as the dividend safety. This shows us that it wouldn't even take them one day to pay off all of their debt net of cash on hand. Absolutely phenomenal. Now, before we do just jump into the valuation, just to let you know, we have released our latest free weekly newsletter article. If you want to grab a copy of this and have access to other ones completely free, just click on that pinned comment below. So let's jump into the valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel for each of these companies, we do run through every single one of these models. However, for NVIDIA, this is really the only one that we do see to be relevant. So we have their free cash flows year on year. Now, the average growth is around 30%. Now, forward looking, we have gone for around 52%. Now, we did see when looking at those free cash flow growths that the market is expecting, in fact, analysts as well, for this to grow more than 100 or in fact 100% from 24 to 25. Now, we have gone for something much lower and lower than analyst estimates, around 52% for the future. But again, this does really depend on the outlook that you have for this product, whether or not you do see the demand to be consistently high for a very long time. So what we've done is we've used this rate with the discount rate to get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get to an intrinsic value that, as we can see here, is overvalued. Now, what I would say is if you do believe that this growth rate is a lot lower, something around 20% just for argument's sake, then you would expect the market value to be significantly higher with the intrinsic value at $106. Now, this would hold true if you do believe that we are seeing an AI bubble, and therefore we would expect that 20% would be appropriate. However, if you do believe, for example, that it is going to go up 100% continue over a long period of time, then this would be significantly higher, around 8,000, which is completely ludicrous. But that's why we have gone for around that 52% level, just to be roughly lower than analyst expectations, but also higher than what they have previously achieved, which, as we saw, they have been on a very strong, phenomenal run. So the intrinsic value for today's episode is purely just of the DCF model, and don't forget you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. Now, margin of safety, whilst we typically use 10% if we believe it has a wide moat, strong financial metrics and good forward-looking data, what we do see here is now that it's currently trading not too far off its intrinsic value at $787. Now, Wall Street, what they're forecasting is upside of 9% with a price target of $857. And the main thing that I would say here is, personally, this is one I hold indirectly via ETFs. It isn't one that right now, or even before, I would be looking to add it as a singular holding. But I would say this really does depend on what you believe the future of AI, and in particular the future of NVIDIA is to AI going forward. Now, if you listen to the CEO on his call a few days ago, he says that he expects the company, and why wouldn't you if you are the CEO, to be more supply constrained as demand far exceeds supply. So he does believe that they will continue to have a large demand for this company and their products in the future. Now, it does really depend on that, whether or not you see that. As we mentioned, that will directly impact the intrinsic value. We've gone for 52%. Like I said, if you do believe this is a bubble and you would look for something around 20%, the price would be down to $106. If you believe that next year, whilst they're expecting 100% for it to continue year on year, then we would have this intrinsic value. So a lot does come down to your expectations in terms of NVIDIA's products over the future. But as we mentioned, 52% is roughly what we're anticipating based on looking at analyst estimates. And we get to an intrinsic value showing it not too far off that current price. As always, let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Goodbye for now.